Welcome to vTalkInsight, Risk Sentiment Daily for February 20th, 2026. A more hawkish Federal Reserve and rising tensions with Iran are colliding with powerful AI and earnings tailwinds, leaving risk appetite finely balanced. Risk sentiment today feels cautious and two-way, with a clear defensive tilt creeping back in. On one side, central bank minutes, sticky inflation, and geopolitical headlines are nudging investors towards safe havens, while on the other, resilient earnings, AI-driven growth, and strong cyclical data are keeping capital engaged in risk assets. Index-level volatility remains contained, but the backdrop is far from calm. The Federal Reserve minutes point to a committee that is hesitant to cut and still willing to consider further hikes if inflation does not cool, reinforcing the higher-for-longer narrative and driving a third consecutive rise in the two-year Treasury yield. At the same time, inflation is proving stubborn, with core PCE staying firm, services and shelter costs elevated, and several voices expecting price pressures to hover around 3% for the next couple of years. Layered onto this is the largest U.S. military buildup in the Gulf since the early 2000s, fears around the Strait of Hormuz, and a visible risk premium in crude, all of which support gold and oil while pressuring equities. Balancing those headwinds, there are powerful supports for risk appetite. AI optimism is being underwritten by record funding rounds, hyperscaler capex plans measured in hundreds of billions of dollars, and evidence of real productivity gains in logistics and other sectors. Earnings growth for the S&P is tracking in the low teens, with beats from companies across retail, industrials, staples, and exchanges, while positioning and flows show investors rotating into emerging markets, cyclicals, and non-U.S. equities. The result is a market that is rotational and dispersion-driven, rather than outright risk-off. The hawkish Fed and sticky inflation are again at the center of the macro narrative. Recent minutes show policymakers reluctant to cut rates and some members explicitly open to further hikes if inflation fails to moderate, a stance that is notably firmer than what was implied by market pricing for multiple cuts this year. That shift is prompting a scaling back of easing expectations and a repricing at the front end of the curve. Underlying data are challenging the idea of a quick return to target. Core PCE remains sticky, services inflation is persistent, and wage growth, while no longer surging, is still elevated enough to act as a floor under price pressures. Several commentators now expect U.S. inflation to run near 3% through 2026 and 2027, as fiscal support, electricity and food costs, and tariff-related price pressures keep the disinflation process low. Resilient labor data, including jobless claims comfortably below expectations, add to the Fed's patience to stay on hold. This higher-for-longer bias has clear market implications. The two-year Treasury yield has risen for 3 sessions, and there is an expectation that front-end U.S. rates could move higher still, especially relative to peers like the UK, supporting a stronger dollar against currencies such as the yen and sterling. Higher real yields tend to pressure long-duration growth assets and raise the discount rate on future cash flows, even as long-end yields remain below levels seen as a danger zone for risk assets. For now, investors are weighing the drag from tighter policy against still solid growth, leaving valuations more vulnerable to negative data surprises than to good news. Escalating Middle East tensions and oil are the second major bearish driver. The U.S. military presence in the Gulf is now described as the largest since 2003, with credible worries that skirmishes with Iran could tip into a more direct conflict. Markets are focused not just on the immediate confrontation risk, but also on potential spillovers across the region and to key energy choke points. That geopolitical backdrop is already embedded in prices. Brent is trading above $70, with estimates of a $7 to $10 per barrel risk premium and regional benchmarks like Dubai crude commanding a premium to Brent. Gold is rallying alongside oil, and there are reports of rising demand for safe havens as equities trade softer on geopolitical headlines. Higher energy prices, if sustained, would feed back into an inflation picture that is already complicated by sticky services and strong wage floors, tightening the policy bind for central banks. There are, however, some mitigants to the most extreme scenarios. Spare capacity from producers such as Saudi Arabia and other OPEC members, and the willingness of Western producers to hedge and add supply into price spikes, suggest that some of the recent rallies in crude could prove short-lived. Selective corporates are also better positioned, as illustrated by airlines with over half of their fuel needs hedged, which cushions them from near-term shocks. Still, with Ukraine's energy infrastructure vulnerable and markets having stayed relatively calm to date, any escalation from targeted strikes to a broader conflict could force a rapid repricing across energy, inflation expectations, and risk assets. Private credit liquidity and transparency stress form the third key downside driver. A prominent manager has restricted withdrawals from a retail-focused private credit fund, reversing plans to reopen redemptions and instead opting to sell a sizable portfolio of direct lending assets to return cash. The move has intensified scrutiny of liquidity mismatches in vehicles that offer periodic liquidity against inherently illiquid loans. The fallout has not been limited to a single fund. Alternative asset managers with significant private credit exposure have seen sharp equity drawdowns, as investors question how robust fund structures are under sustained redemption pressure and how transparent valuations really are. At the same time, rising loan loss provisions at some lenders are reinforcing a broader narrative of building credit stress and the potential for consumer and corporate defaults to rise from very low levels. There are important nuances beneath the headline risk. The fact that recent loan sales cleared at or near par suggests underlying asset quality remains reasonably resilient, even as listed fund vehicles trade at discounts. Other managers are emphasizing strategies in higher-grade private credit with greater trading activity, which they argue offer better liquidity than traditional leveraged loans. For portfolios, the focus is shifting toward the fine print on redemption terms, gating mechanisms, and manager transparency, as much as on pure credit risk. On the bullish side, AI capex and productivity optimism remain a powerful support for risk sentiment. OpenAI is nearing completion of a record-breaking funding round, expected to exceed $100 billion and potentially valuing the company in the high hundreds of billions, with strategic backing from names like Microsoft, Nvidia, Amazon, and SoftBank. In parallel, hyperscalers are planning more than $500 billion of near-term infrastructure spending, with capex growth rates that in some cases approach a doubling year-on-year. This investment wave is already spilling into the real economy. AI-driven data center buildouts are lifting demand for semiconductors, memory chips, power infrastructure, and building materials, while heavy capital expenditure is fueling a surge in imports of computers and capital goods. Commodity demand is benefiting as well, with copper and related inputs seeing strong interest as AI infrastructure accelerates. Companies are reporting concrete productivity gains, such as logistics firms achieving around 40% efficiency improvements since 2023, and there is a growing view that AI could lower costs across healthcare, education, and manufacturing over the next few years. Still, the AI story is not without tension. Record capex is consuming as much as 90+% of free cash flow at some tech leaders, raising questions about the sustainability of current spending levels and the timing of returns. Software stocks have sold off sharply after AI-related news at times, reflecting skepticism about near-term monetization even as management teams remain upbeat. For now, however, strong funding, visible demand for infrastructure, and expectations of rising AI-enabled earnings are providing a meaningful offset to macro and geopolitical worries. Resilient growth and broadening earnings are another important bullish counterweight. Evidence of cyclical acceleration in the U.S. is mounting, with firm purchasing manager and industrial production data, strong gains in non-residential construction employment, and robust investment in data centers and infrastructure projects that extend visibility well into 2026 and early 2027. Lower mortgage rates at 3-year lows are expected to support new home sales, while travel-related demand, especially in premium cabins on transatlantic routes, remains strong despite higher oil and geopolitical uncertainty. Corporate earnings are reflecting that macro backdrop. Aggregate S&P earnings growth this season is tracking around 13%, comfortably above expectations at the start of the year, and recent gains in equities have been driven more by profit growth than by multiple expansion. Beats from companies across agriculture machinery, global staples, retailers, exchanges, and airlines highlight that strength is not limited to one sector. Within small caps, profitable companies and indices like the Russell 2000 are now outperforming loss-making peers, suggesting a healthier quality bias in the rally. Even so, the growth story is not one-sided. A sharply wider U.S. trade deficit, driven in part by AI-related imports, is likely to weigh on upcoming GDP prints, and consumer confidence remains near decade lows as households grapple with elevated prices and borrowing costs. Retail sales are running only in line with or slightly behind inflation, pointing to volume pressure in some areas of discretionary spending. These cross-currents help explain why single-stock volatility is high and why investors are rewarding earnings resilience while punishing misses more aggressively. Finally, global risk on rotation and EM flows are reshaping how risk is being taken. Equity and multi-asset positioning has shifted from mildly cautious to decisively bullish, with systematic strategies and hedging programs indicating much cleaner positioning and reduced downside convexity than a few weeks ago. Significant cash remains on the sidelines, but it is being selectively deployed into areas perceived as under-owned and supported by fundamentals. Flows into emerging market equities have been striking, with roughly $37 billion in just 7 weeks, one of the largest such surges on record, driven more by structural underallocation and supportive fundamentals than by fear of U.S. valuations. Non-U.S. equities are outperforming as global investors pivot toward markets with greater exposure to traditional cyclicals such as materials, energy, industrials, and financials. Within developed markets, equal-weighted indices are favored over cap-weighted benchmarks as leadership broadens beyond U.S. mega-cap tech. Volatility in emerging markets has, in recent stress episodes, been comparable to or even lower than in developed markets, challenging old assumptions about relative risk. This rotation is encouraging for global diversification, but it remains selective. Investors are differentiating between higher quality and weaker balance sheets, as seen in the relative outperformance of profitable small caps and the punishment of over-leveraged names in sectors like used car retail and consumer finance. At the same time, a potentially stronger dollar on the back of higher U.S. front-end rates and Europe's exposure to geopolitical and energy risks are reminders that country and currency selection matter. Overall, the shift in flows suggests that while headline sentiment is cautious, the appetite for risk-taking has not disappeared. It has simply become more discerning and globally dispersed. To sum up, risk sentiment today is cautious and two-way. A hawkish Fed stance, sticky inflation, Middle East tensions, and pockets of private credit stress are keeping a lid on valuations, even as AI investment, resilient growth, and strong earnings underpin demand for risk assets and fuel a rotation toward emerging markets and cyclicals. Watch incoming inflation data, any escalation or de-escalation in the Gulf, and further headlines from private credit funds, alongside the pace of AI capex and earnings revisions, to gauge which side of this balance gains the upper hand. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.